Good morning. My name is Leah Kratz, and I'm one of the co-authors of your financial accounting textbook. In this chapter, Chapter 15, we're going to complete our conversation on liabilities. As you may recall in earlier chapters, we discussed liabilities as it relates to current obligations, and some of those examples that we saw were things such as accounts payable, warranty obligations, and maybe gift card liabilities, among some other possible options. Then we moved into long-term obligations that an organization could have. Those might include notes payable and bonds payable. But if you look at a set of balance sheets for an organization, you may notice there are other obligations we haven't discussed, and some of these can have rather large balances. Examples of these could be deferred taxes, post-retirement benefits, and leases. Now, I will be honest and tell you that these concepts and topics can be rather complex, and if you really want to get a good understanding of it, you need to continue your studies with some intermediate accounting courses. But because they do show up so frequently, I wanted you to have at least a working knowledge of what those balances represent. So again, we're going to give you a brief introduction in Chapter 15 of some of these other obligations that companies incur. We won't get into extreme detail because that would be reserved for an intermediate level accounting class. But I think by the end of this chapter, you'll have a good working knowledge of them. So let's first talk about leases. So as you probably are aware, a lease is simply a contract that allows one party to use property that is owned by another party. And in accounting, we have a couple different methods for how we account for a lease, depending on the terms of the contract. If the contract is written in such a way that the agreement really represents a rental agreement, we call that an operating lease. And in those situations, the rights and obligations of that property do not transfer, nor do the title of the property transfer. Those are operating leases. But sometimes contracts can be written, lease agreements are arranged so that they really do represent at its core more of a transfer or a purchase of the equipment or property. When that happens, we account for the lease as a financing lease, and we'll look at both of these in the coming sections of this video. When a company enters into a lease agreement, they have one of two ways in which they classify the lease. It can either be a finance lease or an operating lease. And as you could imagine, there needs to be some sort of regulation around the classification of the lease. And FASB has identified 5 criteria in which we look at to make that determination. If any one of those 5 criteria are met, we consider it a finance lease. If none of the criteria are met, it's considered an operating lease. And again, the purpose of this is to really get at the essence of what the agreement is representing. Is it representing really a transfer of the asset or a purchase? In that case, it would be a finance lease. Or is it really more representative of a rental agreement, in which case we would classify it as an operating lease? So let's look at the 5 criteria. The first criteria is if there's a title transfer. If title transfers, then really that is more representative of a transfer or purchase of the property. So in that case, we automatically classify it as a finance lease. The second criteria is if there's a bargain purchase option. Now, with a bargain purchase option, what we mean is that there's the option to purchase the asset at the end of the lease term for such a discounted amount that it's almost assumed that the organization will enact that and essentially get title to the property. In that case, again, it's more representative of an agreement to purchase that property, so therefore we classify it as a finance lease. The third criteria deals with the lease term and the life of the lease. If the life of the lease is a significant amount of the economic useful life of the property, we assume that that organization is receiving most of the utility from that property, and therefore we'll classify it as a finance lease. Now, the fourth criteria is somewhat complex and one that we reserve most of our coverage for upper level intermediate accounting classes. But the essence of the fourth criteria is really to say if all of the payments, the lease payments that are made over the life of the agreement are essentially about the same as the purchase price, then we say it really is more like a purchase agreement, and we classify it as a finance lease. And the last and the fifth criteria, it has to do with if there is any alternative use for the property. Sometimes property that is leased is so specific that no other individual or organization would have any use for that property. That particular party is the only one that would find value in it, and so therefore they would be the only ones that want it, and we'll assume that they would have want title to that asset. So in that case, if there's no alternative use, we say it's a finance lease. So again, if any one of these 5 criteria are met, we classify it as a finance lease. If none of them are met, it's an operating lease. You will find out in your coverage during this chapter exactly some of those differences involved in operating leases and finance leases and what the accounting shows on the financial statements. So let's switch topics for a moment and discuss deferred income taxes. Oftentimes, companies will report deferred income taxes on their balance sheet, and these amounts can be quite large. So what's actually being communicated here? What are they referring to? Well, as you know, for financial reporting in the United States, we use US GAAP, Generally Accepted Accounting Principles, which is set by the FASB. You also know that for reporting tax purposes, we use the Internal Revenue Code, which is set by Congress. Now, oftentimes there are a lot of similarities between these two sets of rules, but there's also some significant differences as well. The reason being is because GAAP is used to fairly represent what's going on in an organization using accrual accounting. But the Internal Revenue Code is set so that it will stimulate the economy, or in some instances possibly slow down the economy, as well as promote social changes. So the purpose of the two sets of regulations can vary. And when we have this, we have differences in what gets reported. When this occurs, you see temporary tax differences. So in an organization, they might have, according to GAAP rules, report income. But for income tax reporting, for the IRS regulations, that income might not be reported for some period down the road, and thus the tax associated with that income might be delayed to a future period. Again, when that occurs, we call that a temporary tax difference. And this is actually something that companies like and something that they are encouraged to do. If we think about it, the organization is going to report that income for financial reporting in the period in which they incurred it. That doesn't change. But for some reason, the rules in the IRS code do not require that same income to be recognized till some point in the future, and thus the tax on that income is delayed. The reason this is attractive to organizations is because they recognize the income in the current period, but they don't pay the tax until a future period. They get to hold on to that money, and they can use that tax money in the coming period to earn more money. So this is a very wise strategy that companies enjoy. They recognize the revenue currently for financial reporting, but they delay the payment of taxes until some point in the future. In the meantime, they get to use that money to make more money. Again, we call these temporary tax differences. The taxes will be paid. It's just it won't be paid until some point in the future. So when the organization incurs those revenues and expenses, and they earn the revenue and expenses, they're going to go ahead and report that income for financial reporting purposes in the current period. They're also going to report the income tax expense as well as the corresponding liability in the current period. That tax liability is being reported, but as we know, the IRS code doesn't require that tax to be paid until maybe 2, possibly 3 years or so down the road. When that happens, we see these deferred tax liabilities on the balance sheet. We know the tax is due, but it's not due until some point in the future. And that's how we get deferred tax liabilities on the balance sheet. It's a really interesting concept, and again, it's one that companies really enjoy. The third topic we discuss in this chapter is post-retirement benefits. Post-retirement benefits are the benefits that an organization pays to its current employees after they retire. So if an individual works for an organization and retires from that organization, they've made a promise to that individual that they will cover certain costs for that individual for the rest of their life. Some examples of post-retirement benefits include health insurance, life insurance, and possibly pension benefits, depending on the type of pension that's agreed upon. So if you are an individual working for an organization and you retire from that organization, you could receive benefits from them for the rest of your life. Now, as you could imagine, as an individual works, the organization should be accruing these obligations on their books. They have to show that they have this commitment to this individual for the remainder of their life after they retire. But this does bring about some complications because we're talking about dates that are so far into the future, it's really hard to estimate what these amounts will be. For example, an individual may retire at different points in their life. Additionally, individuals will live various amounts after they retire. There's no way to know how long an individual is going to live after they retire, but these obligations are for life. Additionally, we have no idea how these costs are going to change over the period of the individual's lifetime. We could be talking about dates that are decades into the future. So it's really difficult to quantify what these obligations are going to be because of all of these variables. When this happens, it is important that we report an obligation, but the difficulty is determining the amount of the obligation. So organizations will bring in individuals called actuaries, and these are people that make mathematical computations, understanding risks and various statistics, and they will make estimates as to what these obligations are going to be. Now, obviously, these are obligations in the future, so the accountants will take the present value of those future obligations, and that's the amount that gets reported on the balance sheet. Now, this is a topic that has been debated quite intensely in recent years. Because these are such large amounts and because there's so much ambiguity and unknown with them. But again, it is determined that it's very important to try to make the best estimates that are possible so that we can have some sort of obligation to look to and report for the organization. The last thing I want to cover in this chapter is the debt to equity ratio. Now, the debt to equity ratio is actually very simple to compute, but it's very important and one that a lot of individuals will use when making decisions about an organization. For the debt to equity ratio, you simply take all of the liabilities that are reported on the balance sheet and you divide it by total stockholders' equity on the balance sheet. That gives you the debt to equity ratio. Now, what that is communicating to the decision maker is they're telling the story of how the company acquired the assets that they're using for operations. Are they obtaining the assets through debt financing, or are they acquiring those assets through stockholders' equity? And we know that the stockholders' equity is either through contributed capital or through their operations. This makes a very big difference to individuals that are making decisions, because if an organization is highly leveraged and uses a lot of debt to acquire their assets, they're going to have a very high debt to equity ratio. And in some ways, the debt to equity ratio, if it's high, can be viewed as good, because the thought is individuals are using other people's money to make money. But that a high debt to equity ratio also comes with significant risk, because that money has to be repaid, and it has to be repaid with interest. On the other hand, some companies are very debt adverse. They don't want a lot of debt, and so therefore you'll see a very low debt to equity ratio. In that case, organizations have financed their operations through contributed capital or through their simple operations. Again, the debt to equity ratio is a very important figure that a lot of people use when evaluating an organization and making decisions about it. So we wanted to make sure that we dedicated good coverage to that particular ratio. So by now, we have talked all about assets, and we're completing our coverage and conversation on liabilities. So at this point, you should be able to pick up almost any balance sheet of any organization and have a really good understanding of what's being communicated in the asset and liability sections of those financial statements. And that's what this class is all about. We want you to be able to get comfortable with what you're seeing on financial statements. We want you to be able to look at those financial statements, understand what's being communicated, have a good working knowledge of what's being talked about and what those numbers mean, so that then you can make really good decisions. I hope you've enjoyed this video. Go read chapter 15. I hope you enjoy it, and I hope you learn a lot.